Hi, good afternoon, everybody. I'm Angela Potter and I'm the Relationship Director within Barclays Corporate for Lancaster University. So I've visited your campus many times and normally deal with your Director of Finance and the finance team. We're delighted to be joining you for our second lecture on the subject of ESG. It's a subject that we are spending increasing amounts of our time in discussion around. And I'm delighted to introduce you to my colleagues for today's session. In order of which they will be speaking, we have Olivia Lewis, who is a private banker. She works supporting the charities and non-for-profit team. Olivia is a graduate of University College London. She's completed the investment management certificate and passed level 1 of the CFA programme. Olivia is passionate about sustainability and she's also done the sustainability leadership. And she was awarded the Wealth Breathing European Rising Star Award in 2021. Following Olivia, we have Helen Robinson. Helen works as a director in Barclays Sustainability Implementation. She graduated from Lancaster University in 2010 with a BSc in economics. And worked originally in management consultancy before joining Barclays 6 years ago. A key focus of her work is to design the operating model in order to embed sustainability across Barclays. And in her spare time, she's a school governor, mentor and volunteer for Shift. Following Helen, we will have Lucy Ayres. Lucy graduated from the University of Bristol with a BSc in philosophy and economics. Lucy is our resident vegan as well. I'll tell you that because if I don't, she will. She works in the public sector team, specialising in education and social housing. Very much as myself, I deal with education, but not social housing. She supports clients with day-to-day banking services. Following Lucy, we will have our colleague Will. He'll be on last. He's Vice President in the Public Sector Debt Finance team, leading on ESG. So wherever there is an ESG angle to the financing that we're providing, will engage us with the clients to help structure that borrowing. And there is increasingly an ESG angle to an awful lot of what we do. So having introduced my team, I'm going to hand over to Olivia, who is on first. And Olivia, you might need to prompt us to when you need a slide to change, but we'll try and keep up.
Well, thank you very much, Angela, for the introduction and pleasure to be here. So as Angela said, Olivia Lewis, I really specialise in sustainable investing, and many of my clients are universities like Lancaster, as among many others. So really what I was going to spend a couple of minutes talking about was really the introduction. So Mark may have already covered this in the preamble, but hopefully I won't repeat too much. So to start with, what's ESG, thinking about sustainability, and then I'll move on to talk a bit more specifically about sustainable investing. So here on this first slide, really we've outlined, try at the most simplest high level, what ESG is and what it stands for. So ESG, as Mark said, is environment, social and governance factors. And what they do is they represent the 3 main topic areas which capture all of the non-financial related information about a particular company or entity. These factors, certainly my time working, have become increasingly more important in recent years, and they really help us as both as financiers, as a bank, and also investors to understand how well positioned a company is or isn't to take advantage of opportunities that ESG considerations present, and also mitigate potential risks associated with those factors in the future. I think this is really important for us as an organisation, because if we are lending a company money, it helps us to assess in part how creditworthy they are, or if we're investing money for a client, it really helps us to understand those companies we're looking to invest in, how well positioned they are to be able to generate cash flow and ultimately shareholder returns. There on your slide, you can see on the right-hand side, we've broken down each factor and given a few examples of what comes under each. So for environmental factors, it includes things like greenhouse gas emissions, waste management, resource usage, climate risk, all of the things you'd expect under environment. That one's quite obvious. The next category is the S, so social factors, which really considers things like, when we're looking from an investment perspective, it will be about employee and labour practices, health and safety standards, how diverse is the organisation, how good are they at developing their talent and retaining talent. And then the governance factors there at the end, this is predominantly focused on shareholder rights. So how does the board structure look? Do shareholders have rights and an opportunity to vote? It also focuses a lot on board compensation and then corporate behaviour more broadly. So do these companies align with standard regulation? Are they, maintaining competitive behaviour? Those type of factors. But by analysing all of these things together, what it does is really give us a good internal look at that company and helps us to assess how well run or not it is. So that's what we use it for. It's not about sustainability. It doesn't tell us how sustainable or not a company is, but simply how well positioned they are to face some of these opportunities and risks in the future. We just flick forward a slide, please, Angela. Thank you. So moving on slightly and going to talk a bit about where ESG integration stemmed from and how we've progressed to where we are today with the UN Sustainable Development Goals. So ESG investing, as it's termed here, it's really gained significant process and actually been happening for much longer than most people expect. So the movement really started with simply excluding. So when people were looking to invest their funds, it started with people saying, simply excluding certain industries. So they would say, for example, we don't want to fund armaments because we're not comfortable with certain wars going on. And that's exactly what happened in the 60s and 70s. So there were a lot of social protests over issues like the Vietnam War or apartheid regime in South Africa. And that really led to increasing demand for ethical finance. So people were saying, we don't want to invest our funds and be associated with these things. So that was the first step. So that's the 60s. And then in 1971 was the world's first ethical investment fund was launched, and that was done for the Methodist religion. So that was all done for religious purposes. They wanted to align what they're invested in with their values as an organisation. I think going back to 1971, I think there's often this expectation that ethical finance, ESG investing, sustainable investing is very new, but actually it goes back a long way. And in those following decades after the 70s, that interest and growth in sustainable ESG investing continued to grow. Initially, the focus was really on excluding certain investments, as I said, and it was really on social initially, those social issues relating with wars. But because of the number of environmental disasters that happened in the 80s, the E, or those environmental considerations, gained much more focus. And as that awareness of these ESG issues continued to grow, so did demands for companies to report on these issues. And there was a much greater focus on the relationship between strong ESG management and financial performance. So what we know today is those companies typically that have really good, strong ESG factors or reporting typically are the ones that perform better from a financial perspective, which is obviously important to us as a bank. In the bottom left there, you can see we've touched on where this led to. So after a couple of years of growth, eventually in 2006, the UN launched the Principles for Responsible Investment. And effectively what that is a group of investment managers from around the world came together and became signatories of this code, which effectively committed to them to managing their assets responsibly, so integrating ESG into the investment decisions, and also stewardship activity. So when they have invested in a company, using that capital and that power of voice to encourage them to transition them for the better. That initiative has continued to grow. So today there's over 2,500 signatories around the world. Barclays is one of them, and there's over $83 trillion invested in line with that code. So you can really see 83 trillion is absolutely huge and has real impact on how assets are managed. This was then followed, so it's not just the investing industry. Later on, I think it was 2012, we got the Principles for Insurance, which was the insurance industry. And then in 2019, so much more recently, we got the Principles for Responsible Banking, which my colleagues Angela, Lucy and Will be much more familiar with. So that regulation is coming. And then jumping forwards, we're seeing in the investment space much more focus on sustainability. So I said ESG is a really good look into how well run a company is, but it doesn't tell you if it's sustainable. And to help us do this as investors, helpfully, the UN created the UN Sustainable Development Goals in 2015, and they're effectively designed to reflect a 15-year agenda to improve global sustainability. They're really pragmatic. It's not just about climate change, but they recognise that ending poverty around the world really must go hand in hand with strategies that build economic growth and address a number of social needs. So they include things like improving gender diversity, improving cities, improving access to jobs, access to health, access to education, all while going in hand with tackling climate change and biodiversity loss. I think these goals have been really useful in the finance industry and also in for corporates, because now a lot of corporate institutions, as you can see on the bottom right-hand side of that slide, are now aligning their business practices to the UN Sustainable Development Goals. And as a bank, we measure against them also. And when we're investing, we take them into account when we're choosing which companies to or to not invest in. We can just flick forward, please, Angela, a slide. I thought I'd take a minute just to focus on climate change. So climate action is Sustainable Development Goal 13, and arguably some may disagree, but I think most people would agree that climate change is one of the most pressing challenges of our time. I'm sure you're all aware about the Paris Agreement, but effectively it's a global framework that says that in order to avoid the most dangerous impacts of climate change, we need to limit global warming to 2 degrees and ideally 1.5 degrees. Currently, it pains me to say, but we're definitely not on track to hit this. And really, this chart is here to show the amount of work that needs to be done to ensure we hit net zero by 2050. There's a long way to go. I think predictions by the Climate Action Tracker, I had a look just before this call, and it currently shows that by 2100, so the end of the century, we're currently aligned to a 2.5 to 2.8 degree warming scenario. That's way ahead of the 1.5 degrees, and there's a lot of work to be done. Again, this is useful for us as a bank, for corporates and as investors, because it's all things we can think about when choosing which companies to support. So climate risk we'll come back on to talk about later. I think Will or Lucy's going to talk about that. But in terms of portfolio investment management, it also comes into fore, and we're now looking at how does our portfolio align with certain targets, warming targets, and also how can we encourage the companies in which we invest in order to have stronger, more robust net zero plans.
Olivia, can I interject at that point just to ask?
Yeah.
Has COVID accelerated or decreased the pace of energy transition?
Yeah, thanks, Angela. It's quite an interesting question. I think in the most simple terms, I guess the environment was one of the few positive beneficiaries of the COVID pandemic. All of the lockdowns around the world meant that less energy was used, less fuel was used, in particular globally. None of us were flying anywhere. And I guess some of that benefit has been sustained. So, you know, I'm working from home today. That never happened before COVID. There's much more video conferencing, less business travel, etc. And I think during COVID, these COVID recovery plans, as we've all read and seen on the news, a lot of them is really focused on, if we're going to recover from COVID, how can we do it in a way that aligns with net zero? So that's really positive. I guess on the flip side, because COVID effectively put everything to a standstill, there were a lot of projects that were delayed around the world, renewable energy projects. I think in the UK, we missed 2 big wind farm deadlines. So they've been pushed back. So it's obviously delayed the transition. And then thinking more broadly, I guess a lot of funds have been steered away from renewable energy projects and to other things that are needed. So we've got a cost of living crisis at the moment, lots of other issues, healthcare, a lot of other places where funds rightly had to go to, which put the environment and the transition onto a back burner. I think what is interesting, though, is the war in Russia, you know, the war in Ukraine has really made people think about how our energy mix and where we source this energy from. I think we saw in the news over the past year that Germany, in particular in the EU, had a high dependency on Russia. And I think off the back of that, we'll see a lot of change moving forward, and that will hopefully increase energy transition to more renewable sources. So yeah, that's my thoughts on that one.
Thank you.
Flipping forward, so sustainable investing, sustainability. So This is really the crux of my role. It's an area I'm particularly passionate about. So for me, I believe that the allocation of capital is really one of the most powerful tools we have to drive change in the world. I think it was estimated, I saw a Reuters report at the end of last year that said, I think it's over $170 trillion that's needed to meet the UN Sustainable Development Goals in their timeframe by 2030. That's a lot of money, and I think there has to be allocation of capital in order to get us there. And that can be done through your own investments, your ISAs, a pension, how corporates invest. But really what it comes down to is you have the power to choose where to invest or lend your money. So effectively, as an organisation, we can starve those companies of capital who don't align with our values or the UN Sustainable Development Goals. And equally, on the flip side, we can try and invest in those that do, to give them the capital to come up with those innovative solutions and drive us forward. Sustainability, to define sustainability in the definition we use at Barclays, is lifted from the UN. So what the UN said in their, I think it was 1987, the report, but effectively it's about supporting those businesses that are able to meet their own needs today without compromising the needs of future generations. I think when I put that into context for us and when we're investing for clients, it doesn't mean that you're trying to change the world necessarily, but effectively you're not making things much worse. Can we just flick forward a slide, please, Angela? Thank you. So when we're investing, there's a number of ways you can incorporate this idea of sustainability. There's this organisation called the GSIA, or the Sustainable Investing Alliance. So they list out a range of options, and the taxonomy in the sustainable investing space is particularly interesting. There's a lot of interchange, and we need regulation to come to help us as managers agree what we mean. So one green to someone can mean a different thing to another organisation. Ethical can mean one thing to someone, it's different to somebody else. But effectively, the crux of it is that you have a spectrum. So on the left-hand side, you would have traditional investing, where your sole aim is to maximise shareholder returns, so returns from on your money, all the way through to philanthropy on the right-hand side of the spectrum, which is where you're effectively giving away your capital and you expect no return back. There are lots of shades of that in between. So you can have ethical restrictions, as we talked about, excluding investment from those industries that don't align with your values or don't align with particular goals, through to best-in-class ESG integration, positive alignment, thematic investing. There are lots of different types of investment strategies that fall under this umbrella of sustainable investing that perhaps we can delve into in the Q&A. But what is typically common across all of these, in the public markets at least, is that they all have some level of ESG integration. So looking at those factors, there's some listed on the bottom of the slide there. We use lots of data points when we're choosing which companies to invest in. As I said, it's a way of us understanding the non-financial attributes of the company. And when we do this analysis, we're doing it alongside the traditional fundamental analysis that you would expect. So the usual accounting standards, you look at balance sheet P&Ls in order to understand how financially well-performing a company is. But all of these factors help us to take a slightly wider view, which is really helpful for us in making investment decisions. I think the reality is the brightest students coming out of university, so people like yourselves, really want to work for the best companies with responsible policies. So if a company is well managed, it has good employee benefits, they're much more likely to retain the best talent. And if they have good waste management practices, that's going to be likely have a positive impact on their profit. If they have a good net zero plan, they are better positioned to manage future climate risk. So combining all of these things gives us a good indication as to whether they're going to deliver a shareholder return, particularly when you combine that with the fundamental financial analysis. So at the moment, oh, go on, Angela, sorry.
No, carry on. Sorry, I interrupted too fast.
No, it's fine. I was going to say, at the moment, all of this data is quite difficult to source. So with accounting methodologies, you'll see a set format for balance sheets, P&L statements. Is very set and standardized format around the world. And I'm sure, as many of you economic students, I believe you'll be better positioned to assess those than myself. But with ESG data, there's not a lot of it out there. And when it is available, it's not necessarily in the same format. So that makes it really difficult for us. But there's increasingly more and more data providers out there. So effectively what we do as an organisation is we We work with a company called MSCI, but you may have heard of others such as Sustainalytics or Video Iris. And effectively what they do is they help to collate and standardize this ESG data so that as a bank, as an investment manager, we can use it and implement it into our strategies. I think the most important thing to take away from this is that ESG comes up in all sorts of investment strategies, but is very different to sustainable investing. I'll stop there, Angela. Did you have a...
I did. I wanted to interject with a question. Could you tell us a little about temperature implied portfolio analysis and how that's introduced into portfolios, please, Livia?
Yeah, so ESG is one thing. We can measure ESG and you can get ESG scores. So you can get a AAA rating down to like a CCC, as you would with your academic work. But with temperature, it's interesting. So a lot of sustainable strategies now are trying to align their portfolios with the Paris Agreement, so that 1.5 degree warming scenario I talked about just before. How we measure that has changed quite rapidly. I mean, even in the past kind of year, there's different methodologies coming out. So what we do at Barclays is we look at both. So when we're creating an investment portfolio, we'll look backwards at the data that a company emitted previously and has reported on, but we'll also look at their future implied temperature rise. So the way we do that is we look at if a company has a net zero plan in place, and ideally one that's in line with the science-backed target initiative methodology, we'll look at what that target is, and what we'll say is, based on you hitting that target, what level of warming would that company align with? And then we apply that across the portfolio, and we can get an idea of what, if the whole world was that portfolio, what would the warming scenario be? I think the MSCI All Country World, which is a proxy for the global economy, it's one of the largest indices out there. But essentially, I think that's 2.8 degrees at the minute. So 2.8 degrees is a lot higher than the 1.5 degrees that scientists say we need to get to. So yeah, we're quite a long way off. But we do keep measuring it. And by measuring it, it helps to bring it down as people become more aware of the impact.
Thanks, that's great. Are you ready for your next slide?
Yeah, next slide. I'm trying to be a bit more positive here. So it's a bit doom and gloom, I think, talking about climate and sustainability goals and not hitting the amount of money they need. So what I did want to say is there's a lot of positive impact that can be had by investing capital in line with the UN SDGs, or in particular themes such as climate change or gender diversity, or whatever it may be, the theme that you would like to target. And it's possible to have real and drive real change. So we've got some stocks here that are in one of our standard portfolios that's aligned with the Sustainable Development Goals, and there'll be companies here that you do and don't recognise. I think on there we've got Microsoft and we've got Halma. There's a number of different companies there, and what this does is we're now able to report on, if you invest, say you invest whatever it may be, £100 into this company, what does that actually equate to in terms of impact? So through COVID, for example, for a lot of clients, we would say by you investing X pounds into this company, you've actually contributed to this many thousand vaccines. And that positive alignment is really important, I think, particularly for universities that are investing, as it aligns with demands as the student body, the key stakeholder, but also in your own investments. It can be useful, something to think about, and it's not just about making money, but also having positive change. And just my final point, I will say, because it's always one that comes up in the question, if you have to give up financial return in order to invest sustainably, no is the answer to that question. I hope I've got across that taking into account ESG factors actually is a good identifier of the best performing companies. And so no, for all of the science and methodology behind it shows us that you should not have to give up financial returns. So I will stop there. Very much welcome questions in the Q&A, as I've given a very high level whistle stop tour. But I'm going to hand over to Helen, who I think is going to focus on our climate strategy at Barclays.
I am indeed. Thanks, Olivia. Can I make sure you can hear me okay? Thumbs up or wave from anyone. Amazing. Perfect. Thank you. So thank you for having me today. As Angela said at the start, I graduated from Lancaster back in 2010, which was a very long time ago, it seems. So I'm sure I'm making Kim feel very old at this point, given he's still knocking around at Lancaster and lecturing you guys. So my role now in Barclays is in part of our public policy and corporate responsibility team in the ESG section. I'm not actually an expert in the E, the S, or the G. My expertise is in implementing the strategy itself back into the organization. But it's increasingly becoming part of my day job to know about all of this. So hopefully I'll be able to talk to you very convincingly about this today. So as Olivia said, I'm going to focus on the corporate strategy side of it and particularly what we're doing. So at the moment, we're really focused on climate strategy. The E and S and G goes much, much broader than that, but the other areas are extremely nascent. So at this point, climate is really the focus, and we'll start to see some of the nature and biodiversity and human rights work coming in later. In the climate space, the North Star that we all align around is the Paris Agreement and therefore greenhouse gas emissions. So that's what we have to focus all of this on. And we do that with sort of three different perspectives. These are the three pillars you'll see on the screen. So the first one is our own operations. So we have to look within our organization at our own properties, our branches, our business travel, our suppliers, to look at what emissions are we creating within our own organization. That's actually relatively small in the grand scheme of materiality for the bank, but it's really important that we show leadership and we clean house and we do our own bit as well as looking out into the world. It would be a bit daft to focus purely on our clients without doing our homework ourselves. The second pillar is the most impactful in terms of scale and materiality, and that's our financed emissions. So what that means in practice is, as a result of us financing our clients to go out and build, whether that is solar panels or an oil refinery, we are responsible for the emissions that go out into the world. So the way we consider that is we take a share of the emissions of the clients that we service based on the size of the financing or the size of the deal that we're doing with them. That is enormous because obviously we're a big bank. So the way we have to think about this is on a sector by sector basis. We've already gone through and assessed the 5 biggest emitting sectors that we have: energy, power, cement, steel, and automotive manufacturing. And we've set targets against each of those. We've also assessed our residential real estate portfolio. We haven't set a target on that one because, quite frankly, it wouldn't be within our control to achieve that target. It's hugely reliant on government policy and other changes. And if Barclays was to set a target and say, we're going to reduce the emissions associated with all our mortgages, the only way we could do that would be to only lend money to people who can buy green properties. And that's not fair. From a conduct perspective, our regulators will hate us. So we don't do that. We've set a convergence point, which is sort of an aspiration of where we would get to if the right policy action was taken. So we're continuing to look at the next 4 sectors in that space, and we'll come out with some more on that this year. The third pillar is really the commercial side of the house. So this is how we keep our shareholders happy, particularly in the US, where we see a lot of negative sentiment towards ESG. We need to make sure that we are not seen to be just doing the social side. There is a huge commercial opportunity in this space, and that's where the financing and the transition comes in, and of course everything else that the guys are talking about today and investing. So this is the part where we are financing the transition. In order for the world to move to a low carbon economy, vast amounts of financing is required for new infrastructure, for new power sources, and for every business you can think of to operate in a lower carbon way. And that doesn't come for free. So this is where we set a target as to what kind of financing we want to put out there, what's the scale of financing we want to do. And we do that through our green bonds, our green loans, our sustainability linked products, various other vehicles. Now, each of those 3 pillars, I've done a super high level intro to what they are. They're each in their own right very technical, especially the financed emissions piece, where we're having to really painstakingly go through and say for each sector, what's the value chain, what's the right section for us to measure and to set targets on. I'm happy to take questions on those. I have just about got my head around that stuff, but I won't give that detail here unless it's something you're particularly interested in. Our strategy is completely underpinned by climate risk, and I know that Will's going to talk quite a bit more about this, so I won't say too much other than to say that this is really where we need to understand, if we did nothing, or if the world did nothing, what does this actually mean for our portfolio? So that's where we do things like our really detailed analysis, stress testing. A terrible flood scenario in the UK, what does that do to our mortgage book? And again, this is where the regulators start to get really interested. They want to know that we're doing the right thing by society by having a climate strategy, but really their job as prudential and conduct regulators is to make sure that we're managing the risk and the impact to our book, and that our exposures are safe, and that we are capitalized to manage any kind of stress scenario, whether that is climate or otherwise. So climate related risk is a huge part of this, but it's not one of our 3 pillars because it's just part of what we do as managing the bank. Looking forward, our strategy is going to continue to grow as we build out those additional sectors in our financed emissions piece, as we continue to do more financing, and as we start to bring in the nature and biodiversity angle, the human rights, and one of the particularly challenging but interesting areas on just transition. So how do we support the transition to a low carbon economy, but in a way that is mindful of all the communities that are going to be impacted? And that means, people whose jobs will be lost, people who need to move to new areas because of the building of, solar panel farms, or Indigenous peoples who are impacted by pipelines and so on along the way. So that's a particularly complicated and challenging area. I've gone very, very fast, so I'm happy to take questions on this at the end. But that was my whistle-stop tour of our corporate strategy.
Thank you, Helen. The next slides are going to be spoken to by Lucy, so we'll move on to those.
Thanks, Ange. So if you remember that previous slide with the financing the transition, this is really what I'm going to be focusing on here. So lots of companies making big commitments, net zero by 2030 or net zero by 2050. They need funding to get there. Before I go into kind of the details on the themes, I thought I'd very quickly speak about the two main types of sustainable financing. So you've got green, which is used for financing towards green initiatives, such as super eco-friendly buildings, and sustainability linked. So you can spend those funds on anything, but commit to meeting certain KPIs, such as, I know, getting people into work or reducing your emissions. And usually your margin, the amount you pay on that borrowing, goes up and down depending whether or not you're meeting those KPIs. So focusing a little bit more on the slide, sustainability linked financing has really boomed over the last few years. You'll see that the diagram there provides some themes around driving the growth. Investors are looking to invest sustainably, as Olivia mentioned, so there's definitely demand for it. It's been around for quite some time, so documentation is fairly standard. I remember when we started doing this, it was much more difficult because each one was bespoke, and there wasn't any kind of set processes, procedures to document. New regulations coming into play, which kind of results in organisations having to report and disclose on things such as emissions. This makes it much easier to monitor these sorts of things as part of a sustainability linked loan. And companies are thinking about sustainability a lot more widely, thinking about things like DEI, not just kind of emissions. And since COVID, there's been a lot more focus around kind of supply chain. So really thinking about how companies can support their own supply chains to be sort of more ethical, resilient, and sustainable. And should we go to the next slide? Thank you. So thinking about creditworthiness of borrowers, we've always looked at things like liquidity risk, credit risk, regulatory risk. ESG is a fairly new risk, which is very much integrated into our risk assessments, increasingly so. Climate risk is probably the most sort of defined and quantifiable. You can split it into two types of risk: transition and physical. Transition is exactly what it sounds like, the changes that you need to make as a business to adapt to new legislation, such as low carbon technologies to meet net zero commitments. If you have, for example, lots of companies moving away from oil, there's a risk that oil refineries might become a stranded asset. Because no one wants the oil that is being produced from that oil refinery. Thinking about physical risk, that's more direct. So say a drought or a fire that is a direct result of climate change. So an example could be a company that's based right on the coast, and then rising sea levels could potentially cause it to flood. On the right-hand side there's a couple of graphs which show or try and show how investors integrate climate risk into their models when they're thinking about valuing a company. So it would impact basically the ones that have the biggest potential negative impact have the biggest negative enterprise value judgment. So the top one looks at sectors. So oil and gas, there very much the biggest reduction. The second one looks at specific companies within a specific set and the impact on those indices.
I've got a couple of questions to slot in for you, Lucy, if that's all
Sure.
right.
Yeah.
To what extent do you think the banking sector integrates ESG factors in internal processes and credit assessments?
So it's increased massively in recent years. So I also graduated in 2010, so I've been at the bank for 10 years. And when I first started looking at these sorts of things, there were bits and bobs, but now it's a really, really big factor in processes and assessments. The Bank of England stress test now includes climate change, and all banks have very much kind of hired teams that effectively deal in ESG specifically. And looking at kind of those three policies, as we mentioned, those three kind of pillars, as we mentioned earlier, and making sure that we structure our facilities in the right way to ensure they are actually sustainability linked or do actually meet those green commitments. I think historically equity markets are a little bit ahead of banking, but I think the banking sector is very much catching up.
Thanks.
And to kind of build on.
Yeah, we lost somebody there. Was that Will?
On mute.
Are you on mute, Will?
Sorry. Me and Lucy have been sat in the same room, so I probably chipped in unhelpfully here and trying to make the technology work. But yeah, so just to kind of, I guess, broaden out from a credit perspective. So you know, yourself, Lucy, obviously work very closely with the education sector. How is that? How does this kind of fit in with say a higher education borrower? There's obviously a huge risk and around how, say, universities may transition to net zero by 2030. There's a lot of, for example, spend that will be required on a campus to get that campus to net zero by 2030. And so from a credit perspective, as someone who is lending money to the sector, from our perspective, it is understanding exactly how the university is going to, say, fund that work, how they are costing that work, and essentially, you know, fully understanding the financial risks associated with it, whilst also looking at things such as the physical risks that Lucy's obviously already covered.
Thanks, Will. And are there sectors which are particularly active from a sustainability perspective in terms of commitment and strategies?
I'm happy to take that as well, but Lucy can obviously chip in. Well, and I can cover it a bit more in the next slide, actually, if you want to kind of go on to that.
Sure.
That might be it's probably a bit neater.
Yeah. Okay.
So yeah, and good afternoon all, and sorry for jumping ahead of my spot in the slides. Very rude of me. But just to give you a bit of background in terms of my job, so I work within our public sector debt finance team. So essentially get roped in by Angela and Lucy as relationship directors whenever any of their clients want to borrow money, or we're looking to restructure existing debt limits with clients. So I'm just going to give a bit of an overview as to how ESG is permeating kind of across that funding market. So partly building on some of the themes that Lucy's already touched on. So if you're a corporate that wants to raise debt in the market, there's kind of two key ways in which you may do that. Number one, you might go to a bank and say, can we have some money? And so that will sit on the bank's balance sheet, and we will lend you money on certain terms for a certain period of time. Realistically, that'll be in the kind of the fairly short term range, so between say 1 to 5 years. Banks don't tend to have too much in the way of appetite for longer dated lending at this stage. There is some kind of more 10-year funding, but certainly in the corporate space, the on balance sheet lending, the majority of stuff is in that kind of 3 to 5 year space. If you want to go down the more long-term route, you may go to the capital markets. So a bank like ourselves, we might facilitate, say, the university raising a bond in the public or private markets. So we would essentially loop in investors to provide money to the university on certain terms, and so you may be able to borrow for a far longer period here. So say in the kind of 10 to 40, 50 year space, and there's a lot of kind of demand for debt from things such as pension funds and insurance funds. And so what we've seen over the last 5 years is certainly a huge uptick in sustainable financing, and to the extent it's kind of become a key factor across both markets. So Lucy kind of outlined it previously, but there's these two key types. So number one is use of proceeds, green financing. So for example, we lend Lancaster 10 million quid, and a specific energy efficient BREEAM excellent building is built by the university. So the contractual obligation is that the borrower must use those proceeds for a very defined and specific set of purposes. The second type is sustainability linked financing. So where we may lend the university, again, 10 million quid, but this time you can spend it on whatever you want. And there's no kind of restrictions there in terms of what the proceeds are to be used for. However, the pricing on that loan is linked to whether the university meets or doesn't meet certain ESG goals. So, for example, we have done one fairly recently for Bournemouth University, where the pricing on their loan is linked to them reducing their Scope 1 and Scope 2 emissions, but also from a more social perspective, the decrease in the attainment gap from minority versus white students, and the increase in participation from underrepresented demographics. So putting a facility in place which is very much linked to their goals across both ES and G. So those are kind of the two key types here. So in the graph in the top left-hand corner, you can see the way in which this has grown over the last 5 or so years. So hopefully you can make it out, but those grey bubbles at the top are the kind of the proportion of the total loan market issuance. So in 2021, when things spiked, essentially 1 in 4 loans was could be classed as sustainable finance. The vast majority of that, about 90%, is sustainability linked financing, and the green slice on the top is specific green use of proceeds financing. The market issuance in 2022 and 2023 has obviously been slightly depressed given the macroeconomic situation, but we're still seeing kind of 1 in 4, 1 in 5 facilities that would be classed as sustainable financing here. So, and then kind of, Ange, building on your question, the reason that we tend to see this difference here between the amount of sustainability linked versus green is that use of proceeds element. So restricting the use of proceeds to, say, a borrower having to fund a specific asset is obviously can be slightly inconvenient for some borrowers, and so unless there is a specific transition plan to get to net zero with specific assets that need to be financed, then it's often that a borrower will go down the SLL route because they could just use the money for kind of general corporate purposes. So in terms of sectors where you see green finance being more pervasive, that's kind of in the utility space, in the real estate space, because, say, there's a specific asset there that you need financing for, whereas it's less so in, say, something like the retail space or the food and beverage space. SLLs, however, are far more common across all sectors because of that lack of restriction around the use of proceeds. My strong expectation is that we will start to see more green financing specifically. So as companies begin to understand exactly what that transition strategy looks like, if they, for example, set 2030 net zero goals, or if they're obviously further down the line, once they begin costing what it's going to take them to get there and what they will need, then I'm sure we'll start to see more in terms of actual kind of formal use of proceeds financing requests. In terms of kind of, I guess, the benefits to a client of going down the sustainability linked route versus, a pretty standard corporate loan, they're kind of twofold, I think. So potentially you could get lower costs here. So if you meet your ESG kind of pre-agreed goals, then certainly qualify for a margin discount. That can be quite marginal. So you do sometimes see the cost of doing that outweigh the benefits. And then similarly on the green side of things, banks such as ourselves are able to tap into slightly discounted capital if we're going to be lending it out for specifically green or social purposes, and then that has a bit of a knock-on effect in terms of the cost of borrowing from a client's perspective as well. So number one is probably on that cost side, and then the second one is around the building out of that ESG story. So if you're a FTSE 100 company, you need to demonstrate to your shareholders how you're taking ESG seriously if you want to continue to have a decent share price, have customers who want to carry out business with you, and that's a core aspect of their strategy going forward, linking their financing to that and shouting about their story, and it all builds into that picture and helps kind of provide that overarching view as to how they're kind of incorporating ESG within their business models. Ange, I don't know if you want to go on to the next slides.
Well, I had a question actually, Will.
Okay.
If that, well, I have to keep popping up with them, sorry,
Absolutely.
don't I? Yeah. Are clients ready to tap into ESG markets? And if not, how do you support them in that aspect?
So I mean, it really depends on the borrower. So as I say, I deal very closely with housing associations and universities. They are both very much well placed to tap into the market. The reason being is their business models already are inherently sustainable. So from a social housing perspective, they provide low cost homes to vulnerable people, which is a huge tick in the S box. The amount of social impact value that they generate is huge. They're also undergoing a massive retrofit and energy efficiency drive on their existing properties, and so they're very well placed to, for example, take advantage. And likewise on the university side of things as well, the provision of education is obviously an SDG, the number of which I can't actually remember, which is not so good, but that's obviously inherently a social good, and so borrowers who have a very defined social and environmental purpose or a specific journey to go on are very well able to tap into the markets. Where someone is not so able at the moment, it's mainly about understanding where they are on that journey. So for example, we have a tool internally where we will almost classify clients as to where they are on the journey in terms of being right at the start, or whether they're a real kind of pioneer in the space. And it's about having that conversation, helping to prod them, push them, and get them to kind of start thinking about it and understanding what that transition journey looks like. It won't be that, say, a sustainable loan would be relevant for a large number of borrowers at this stage, but it's getting them in a space as to when say a borrowing requirement does come, that these are things that they are thinking about and at the forefront of their minds.
Thanks, Will. We'll move on to the next slide for you.
Cool. So the next two are just some pretty high level case studies of two fairly recent facilities. So this one is for a housing association called Vivid, which we did this year. So Vivid are a pretty huge housing association in the southeast. They manage about 35,000 social homes. So provide that low cost, affordable housing for vulnerable people. We did the first green loan in the sector, which was a £50 million 10-year loan. So because it was green, we were able to stretch that standard tenor, which I spoke about earlier, and that was to build specifically 300 new energy efficient properties. So because it was use of proceeds specific, we needed them to demonstrate to us upfront exactly what that was going to be spent on, the emissions intensity of the buildings in which they were financing, but also providing us with invoices which demonstrated that actually this is what we will be purchasing and spending the money on. There's a lot of governance both internally and externally around green and sustainable finance these days to ensure essentially that we are doing what we say we're doing, and there is no kind of greenwashing from a so you have bodies such as the Loan Markets Association who have very defined guidelines as to what we can and can't be doing, and what we need to be ensuring we're evidencing as part of these transactions. And then so alongside that green loan, we also had a sustainability linked loan. So this is a revolving credit facility, which is kind of like a glorified overdraft for a corporate. And so this facility was linked to the development of at least 1,000 new affordable homes a year. Their Vivid's ability to generate kind of multiple millions of welfare payments for their tenants per year, and then also ensuring that they continue to have the strongest governance rating from their regulators' perspective. So kind of again across the ESG to demonstrate that full story. And if we can go on to the next one, please. And then the final one is just in the more kind of wholesale market. So this was the first sustainability bond in the education space for UCL. So UCL took out 300 million across 40 years. They have what is called a sustainability finance framework in place, which is essentially a document that says we're going to raise some money and it is going to be spent on these exact things. So apologies for the tiny font, but essentially they have committed to over the next 40 years spending 300 million in decarbonising their estate, but also around providing some social kind of socially beneficial activities as well. So things like scholarships and bursaries, and undertaking kind of research into impactful areas as well. And so what you have seen in the market, especially where you've got something like this, which is the was first in the HE space, is that because it's very a sustainability issuance, a very good credit, there's very strong demand from investors. So I think they wanted about 250 million originally. They had bids for around about 900 million that came in. What that means is they're able then to drive the price down and also upsize the transaction because the price is looking so good. I mean, Mark's commented in the chat, all in at 1.73% for 40 years is something everyone will be biting your hand off for these days. Is lower than most, well, pretty much all mortgages now. So yeah, very good rate from UCL there. Andrew, I think that's me, so I'll hand back over to you and whoever is next.
Thank you, Will. That's great. So the next slide is Helen and Olivia are going to speak to this one, and it's really about what's happening out there in the jobs world. Can I get Helen first, maybe, please?
Yeah, happy to start. The bit I can add colour to is actually less of what's on the slide and more of the kind of I guess the implementation and the corporate strategy side. So a lot of what we're talking about here is the offerings in the ESG industry on the investment side and on the financing side. But there's also kind of the need for ESG expertise in every aspect of a corporate, whether you're in risk, you're in finance, you're in real estate, you're in operations, even if you're in HR, ESG is weaving its way into every aspect of running a business. In compliance, every time I think of a new function, they are being drawn in. That's a process that we at Barclays are doing at the moment, where, if you asked us 2-3 years ago, there would have been 20 people in the bank doing ESG, and that is now federated across the bank. We've got people in policy, we've got people within each of those businesses and people within each of those functions. So there are roles everywhere in every organization, really. So if you want to come at this from a risk professional or from an economics professional, where you're wanting to look at the academic side of things, you want to be a policy person, you want to be a compliance person, there are roles in the ESG space in relation to any of those kinds of things. I'll let Olivia talk a little bit more to the actual financing side.
Yeah, thanks, Helen. I guess there's some roles there on the screen which are quite broad and generic. I think the best way to think about it, when we have graduate schemes, I know certainly in the private bank on my side, in corporate bank, and to our functions that Helen's referred to, so HR, compliance, any of those things, the best way to think about roles I think, is to bucket them into 3 areas. So you've got relationship roles, relationship management roles, so client-facing roles. You have product roles, which is where you manage and run a particular product that the bank is selling, or if it's an internal function, a particular solution that the business needs. And then you have strategy roles, which are really thinking about the strategic elements. So I guess from Helen's consulting background, like how is the business run, and Helen's area, what are we doing from our own business perspective? But also it can be about which clients and customers are we targeting, where and why, what products and services are we taking out. In each of those 3 buckets, I think you will now find roles related to ESG, sustainability, and exactly, I would agree with Helen, it's weaving its way into every area. I joined Barclays 8 years ago, and in my time I've seen a rapid increase in the number of roles. So people like myself, Lucy, Angela, we sit in that client bucket. So we're having to all get very good at advising clients and speaking to clients about ESG and sustainability. So there's that area. On the product side, you might want to run a sustainable investment portfolio, do stock research. You might be helping customers to issue their own sustainable bonds. You might be working in the area that Will talked about, where you're advising on how clients and customers can borrow funds in a sustainable way. And on the strategic side, it's roles like Helen's, exactly how do we define the Barclays strategy, the policy, and I guess from an investment, from my background would be which markets are we targeting and why. That's kind of a whistle-stop tour, and I can see there's a number of questions in the chat. I saw someone asked about qualifications, so I'll try to tackle that one now. Each department within the organisation will have different qualification requirements, but when graduates join us in our business, and I think I'm safe to say this across the whole of Barclays, we don't expect people to have kind of industry or professional qualifications. We're very much looking for people that show the right skills and attributes, but we don't expect you to come out of university with a whole load of professional qualifications. Barclays is very good at funding and supporting us to do those qualifications. On the investment side, there's a number of ESG qualifications you can do, which I can go into more detail if people want to know, or send across afterwards. And I'm sure Lucy and Will the same on the corporate side. There'll be a number of qualifications you can do if you want to do them.